people are stuck in their not just money silos, but like capital silos, unless they're wealthy enough to have like foreign accounts and things like that. And one thing that technology can do, if we let it, is give people more global competition, more global access to the best assets in the world, rather than be restricted to whatever assets happen to exist in their own jurisdiction. So it increases if people want to hold dollars, if people want to hold maybe the S&P 500, if people want to hold Bitcoin, if people want to hold a gold stable coin, these are ways to.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about crypto, market, and money. Lyn Alden say, since money is supposed to streamline transactions, it nearly seems to be failing in that regard if there are 160 different currencies. In addition, as we'll see in a moment, money is typically becoming more digital, but that requires different forms, such as central bank digital currencies that kind of further and open source money like Bitcoin. The control, and then there are alternatives like as stablecoins or hybrids, which are essentially means for one nation's currencies or resources to breach any of the 160 distinct financial obstacles surrounding currency blocks and essentially provide those individuals with additional choices. So if you're residing in Nigeria, for instance, generally speaking, what you want is something you know is within your reach, like local real estate, not interested in holding local currency because, as you may know, the capital markets there are not as developed as the US gets. Investing in the S&P 500 isn't as simple as it once was, which is why individuals are trapped in their capital silos rather than just their money silos until they are affluent enough to own overseas accounts and other like things. And if we allow it, technology can provide people with more worldwide, more global competitiveness and access to the greatest resources available, as opposed to being limited to whatever resources exist under their own jurisdiction. Hence, the demand for dollars rises if more individuals wish to possess perhaps S&P 500 if people wish to own Bitcoin. But you are aware that these are also popular gold stable coins. These methods are nearly identical to banking offshore for the middle class. This is what certain technologies are capable of, and lots of things Lyn Alden discuss, so please watch the video to end and share, subscribe our channel Everyday Finance. Thanks.
A couple key takeaways are a mental model of thinking about money. So people say, is it metal? Is it people say it's an IOU? Like, what is money? I think one way of thinking of it is money is a ledger. And so you have to be very careful which ledgers you choose to trust. So that, basically those who control the ledger, if anyone controls it, can dilute you out of it or can freeze your ability to use it. And so when you think about money as a ledger, whether it's a literal ledger like a central bank currency, or whether it's nature's ledger like gold, or a more inflationary commodity like copper, for example, you have to pick your ledger carefully. And they have different characteristics, and it's an interesting exercise to walk through. What ledger am I using? Who controls it? And what else could I be using? And I think another takeaway is to realize that for a century and a half, we've had increasing transaction speeds compared to the physical world, and so it's kind of necessitated more and more centralization and abstraction. But that has also brought with it a lot of the problems we've just talked about. Basically fiat currency, inflation, almost like currency barter on a global scale. Mm-hmm. Money is meant to unify transactions, but if there's 160 different monies, it almost is failing in that way. And then the last one, I explore kind of the fork ahead for money's generally going more digital, but that takes different forms. So for example, there's open source money like Bitcoin. There's central bank digital currencies that kind of further the control. And then there's hybrids like stable coins, which are basically ways for one country's currencies or assets to pierce any of those 160 different, financial barriers around currency blocks and basically give those people more options. And so if you're living in Nigeria, for example, generally what you want is something, your options are real estate in the local area. You don't want to hold the local currency. The stock market's not as, the capital markets there are not as developed as you're going to get in the US. It's not like you just go out and invest in the S&P 500. And so people are stuck in their, not just money silos, but like capital silos, unless they're wealthy enough to have like foreign accounts and things like that. And one thing that technology can do, if we let it, is give people more global competition, more global access to the best assets in the world, rather than be restricted to whatever assets happen to exist in their own jurisdiction. So it increases if people want to hold dollars, if people want to hold maybe the S&P 500, if people want to hold Bitcoin, if people want to hold a gold stablecoin, these are ways to, it's almost like offshore banking for the middle class, is what some of these technologies can do. Mm-hmm. And so I think a big takeaway I have is that there's a fork in the road between either more centralization, basically for a century and a half, we've made the system more and more efficient, but more and more centralized. And we can either continue that path with CBDCs, which I would advocate against, or there's the more open path of actually trying to tie these systems together more, make capital more globally portable and accessible in the more open source way.
According to Lyn Alden don't necessarily anticipate fireworks while we have this tightening situation. I do enjoy long-term accumulations of gold and Bitcoin, and I would be cautious when it comes to total equity exposure, but I find T-bills to be interesting. I mean, the money supply is not a problem as long as you can make, say, more than 5% on these kinds of assets at a time. Expanding swiftly, huh? There's this window here where that seems to make sense in the long run. I would anticipate by maybe late 2024 or early 2025. Would most likely see another prosperous cycle of liquidity, and I would like to hold more liquidity-driven resources.
I would like to think so. I think they would look back, kind of like how we look back, in older technology times and think like, why were things like that? Or what would have life been like in that environment? I would like to think that far in the future, people will look back and just think like there were like 160 different currencies and people were just dealing with like 20%, annual currency supply growth just year after year and just couldn't do anything about it. And like what an insane situation. Or just the overall general policy of, due to technology driven deflation. So on average, we get marginally better at making things year after year. And yet, so prices should go down, slowly over time. And yet central banks do everything they can to make prices go up over time. And that has all sorts of semi-invisible issues throughout society. It warps, money is, ever since, Hayek explored this topic, money and prices are a signaling mechanism. It's how we come to consensus on things. It's an efficient way to share information, money and price, transactions. And by messing with that in a centralized way, that has implications. And so I would like to think that, people will look back on this period and think like this was a local maximum. This is not the best that money can be. And that this was also a period where a lot of things emerged, which hopefully, 10, 20, 50, 100 years from now, I would hope that it's a better monetary environment than there is now. So I think that as long as we're still in this situation where the Fed is trying to tighten, risk assets have a very mixed outlook. And there's all sorts of things like basically if in the next 8 months we either do have an energy crisis or we don't, that'll obviously affect things. Like, almost every prediction has a Boolean outcome based on energy prices. And so, like I said, I'm increasingly finding tips interesting. I do like gold and Bitcoin as long-term accumulations here. I don't necessarily expect fireworks while we have this tightening situation. And I would be cautious around overall equity exposure. I think T-bills are interesting. I mean, as long as you can earn like over 5% on these types of assets at a time when money supply is not growing quickly. There's this window here where I think that makes sense. When we look out longer term, I would expect by maybe late 2024, maybe 2025, we'll probably have another positive liquidity cycle, and I would want to own, more liquidity-driven assets.